Hello, this is Rob Ballash, and I run Burford's Investor Relations outside the Americas. I and the whole team at Burford welcome you to today's 2026 Retail Shareholder Audio Webcast with Chris Bogart, Burford's Chief Executive Officer, and Jordan Leach, Burford's Chief Financial Officer. Thank you for your interest and, in many instances, long-standing investment alongside Burford's employee shareholders who own today around 10% of the company. We hope you find this forum useful. Before I hand over to Chris Bogart, some housekeeping. After some brief opening remarks from Chris, we'll move to Q&A. You can ask a question at any time by submitting it in the Q&A box that you see on the webcast dashboard on your screen. This is discreet to you and us. If you have any technical questions for the production team in our virtual green room, you can use the same private Q&A box for that purpose. We'll try to get through as many questions as possible, but due to the fixed time available, we likely won't be able to respond to each of them. A selection of the questions we've already received are grouped by topic. We plan on getting to each topic that's been raised. If there are any new subjects from the live Q&A feed, we will certainly try to get to those as well. Finally, a replay will be available to registrants a short while after today's event using the webcast registration link you've been provided with. And with that, I'd like to turn the call over to Chris Bogart, Burford's Chief Executive Officer. Absolutely, Chris. So let's move straight away to our first area of inquiry, which is around growth. And we've obviously had several questions about this topic, specifically the outlook for continued strength in new business, the funding of that growth, and Burford's 2030 growth target. To bring the crux of these together, because we really have had many, and with specific thanks to shareholders Jenny Jaspers and Nam Young Koo, there are three questions. First, what are Burford's growth prospects as we stand today? Second, will organic cash generation be sufficient to meet the funding requirements of this growth? And third, do you still view the doubling of the portfolio base between 2024 and 2030 as achievable? Thank you, Chris. Our next question is on the subject of growth and leverage, and it comes from Ilya Efimov. Following the YPF write-down, leverage metrics increased materially despite substantial liquidity and having no significant debt maturities until 2028. What are your capital allocation priorities over the coming period, including target leverage, and what milestones would indicate leverage has returned to a level where you can focus aggressively on value creation rather than balance sheet management?
Sorry, Chris. No, I think, the simple answer with respect is this is, as you mentioned before, in the answer to the first question, which is we never operated the business with a day in which YPF was going to resolve or with respect to using the YPF cash flows to address the capital structure in the immediate term. And so when you think about how we operate going forward, obviously there's a constraint on the incremental leverage, but that wasn't something we were planning to do to begin with. And so as the business continues to perform, the generation of cash flows as well as the building of the book and retained earnings will bring the actual GAAP leverage number back into normalization.
Thanks, Jordan. So the next question is actually related to realizations and also comes from Ilya Efimov. Many investors understand Burford's value depends on the conversion of portfolio assets into cash rather than on any large single matter. Can you help us understand how you view the pace of realizations and cash generation over the next 12 to 24 months? And specifically, what key indicators should shareholders monitor to determine whether the portfolio is performing as expected? We have a question from Ewo Morks on portfolio returns. Is it fair to expect that the trend of the last 4 to 5 years, being a small proportion of adjudications relative to settlements, combined with lower ROIC on adjudications, will continue? Alternatively, do you see reasons why adjudication ROICs should trend back towards the higher levels of the past? What actions is Burford taking or can take to reverse the recent settlement adjudication trend? Thanks. Next question is on duration. Weighted average life of active capital has increased from around 2.3 years historically to 3.4 years today. To what extent is this driven by temporary factors such as court backlogs and slower litigation, compared with a deliberate shift toward larger and more complex cases? More importantly, should investors expect capital duration to trend back to historical levels, or is 3.4 years or thereabouts the new normal? Thanks, Chris. We've got a related question, which you've answered in part, Chris, but I think it's an interesting one, and so I'll persevere with it, and you can see whether you think you have answered it to the extent you'd like to. And it relates to effectively risk asset selection and duration. And it comes from Nam Young Koo. Since the reference to trying a few more Petersons in Burford's 2023 shareholder letter, we would expect the share of definitive commitments to higher risk assets, particularly those in the 25% plus risk of model risk of loss band, to have increased. As the weight of these assets grows, our riskier assets, is there a material possibility that the overall portfolio weighted average life will rise meaningfully above current levels? Thanks, Chris. Okay, let's take a drill down into the next layer, and we've got a question on the protein claims family. It comes from Benny Jaspers. Can management provide a definitive update on the trial timelines for the Cisco antitrust protein cases? If an outside settlement or treble damages award occurs in late 2026 or 2027, is that single realization large enough to unilaterally cure the current book equity deficit? Thanks. A couple of questions on YPF. The first from Bruce Anderson. How can the Second Circuit decide the YPF case should not be heard in the United States courts and ignore the fact that in 2018 the Supreme Court refused to interfere with the Second Circuit's prior decision to allow the case to proceed in the Southern District of New York? The second YPF question, Chris, is as follows. Following the Second Circuit decision, the firm has signalled a pivot to international treaty arbitration. Given that ICSID proceedings against sovereign nations routinely take upwards of a decade and carry substantial legal fees, what is the specific forward-looking budget allocated to this arbitration, and what is the expected drag on operating margins? The next question relates to AI and efficiency. It comes from Gabriel Cazorla Person. How is Burford deploying AI? Do you see significant cost reductions? Do you think it could lead to even better returns on capital? A question on operational efficiency from Peter Richmond. It would be useful if you could say something about the split of costs between running the existing book and developing new business, i.e. the expense of new business strain. How do you think about cost management, including interest expense?
No, I've always said one of the allures of our business and how we do retain people is that they are not billing by the hour and tracking every 6 minutes. And so it's something that we don't do. And I think, Chris, you described uniquely the way in which our business operates. And so obviously we are conscious and using internal metrics to understand where we're spending our time and if we're spending our time efficiently. But we don't have a kind of public breakdown of new business versus old.
Thanks, Sean. So the next topic is valuation. A question from Bruce Anderson. While Burford is larger and stronger than it was before its US listing, with share price halving versus its closing price on the eve of the New York Stock Exchange listing, the company clearly isn't more highly valued after listing in the US. In fact, the valuation gap, the difference between the underlying value of the business and the market capitalization, is wider than ever. Why is that, and how do you plan to address it? Thanks. Next question is on dividends. It comes from actually a couple of questions, Trevor Griffiths and Colin McPhee. While I agree the priority is to reduce leverage, the probable passing of the dividend, which is being flagged, sends the wrong message to shareholders. Directors and staff have been very well remunerated, and shareholders don't seem to be sharing in the successful deployment of their capital. Cutting the dividend feels like shareholders remain very much at the back of the queue. Please comment. Question on share buybacks from Lucas Amaro. I understand that the primary strategy is to deploy capital to fund growth with the objective of doubling the portfolio base to 4.8 billion in 2030. However, there must be a valuation threshold at which share buybacks become more compelling. Could you please provide insight on your framework regarding this trade-off and outline any potential plans to capitalize on buyback opportunities?
Sure. Sorry, Chris. Well, look, I think obviously we have historically talked about the opportunity to buy back shares and to use capital to do that. And one of the things we've been consistent about is deploying capital into the business to continue to fund new assets and build, shareholder returns in the retained earnings of the business through the asset growth, and not taking on leverage to go buy back shares. I think given the question that Chris just answered, we do live in a world where there are gap covenant levels, and I don't want to say never because that would be inappropriate, but we do want to make sure that we're in an appropriate position to maintain the capital base, and so buying back shares at a certain stock price, while it could be attractive, also has the reverse impact on the gap leverage covenant levels, and so we have to be mindful of that in the near term.
Okay, thanks. We have two questions on new initiatives from Gabriel Cazorla-Person and Tom Trajian. You've mentioned that because non-lawyers aren't allowed to own law firms in most of the United States, this prevents some business owners from monetizing their lifelong investments. This is painful when the AI revolution will require increased investment to stay in the game. Acquiring law firms at attractive multiples would be a logical step for Burford. Is Burford lobbying for change on US law firm ownership rules? And how could Burford exploit such an opportunity? Relatedly, also, how are Burford's investments in law firm PCB Byrne and legal consultancy Kindleworth performing? We have a question from Jonathan Wellham on regulation. Given the growth and interest in legal finance, is Burford well positioned for potential increases in regulation, such as the recent push for federal legislation in the United States to mandate transparency of funding and restrict funders from directing settlement strategies? Thanks, Chris. Our next question, and looking at the hour, probably this ought to be our final question, Chris, is on international growth. It comes from Peter Richmond, and it's as follows. As a global business, could you comment on Burford's international market plans and your views about the optimal level of geographic diversification for the business? Thank you, Chris. And if I could just issue one reminder, which is replay facility will be available shortly after the event via the same webcast registration link that you used to access today's audio webcast. As always, we encourage you to reach out to us with any follow-up questions through the usual channels, or you can email ir@burfordcapital.com. Thank you again for participating and enjoy the rest of your day.